So good evening, students. Welcome back. Today we are going to discuss chapter 18, that is miscellaneous provisions. Before we begin the topic, let us have a very brief overview of what we are going to discuss, and then probably we will touch upon each of the individual topics. So the first topic that we are going to discuss is section 269 SS, section 269T, and section 269ST. These sections we will collectively discuss, and largely these sections contain the restrictions in relation to certain modes of taking or accepting any loan or deposit or specified sum or the repayment thereof. Mode of accepting, taking any loan, deposit, or specified sum, or the mode of undertaking a particular transaction. So basically, these sections restrict the circulation of cash in the economy, and the provisions have been amended from time to time to make it more stringent, and there is a reporting requirement and penalty that follows. Then thereafter, we'll also be discussing section 285B, 285BA, and 285BB. Now, these sections are relating to obligation on the part of certain entities or specified organizations or persons to report the particular nature of transaction. For example, section 285B requires the producers or those production houses that produce the films or documentary films, or they organize the events or undertake any kind of specified activity as contained in the section, to report certain specified expenditure or payments with the income tax authorities. Section 285BA, which is statement of financial transaction or reportable account. Popularly in practice, we call it as an SFT reporting. Now, this section requires certain entities or organizations or persons to report the transaction with the income tax department in the electronic form. Transfer to defraud the revenue is treated as void, section 281. Now, this section deals with the power of income tax department to treat any kind of transfer as invalid, illegal, or void ab initio if the primary objective of a particular transaction or a transfer was to sort of circumvent the provisions of law and evade the taxes. Section 281B, which deals with the provisional attachment to protect the interest of revenue. As it suggests, it empowers the Central Board of Direct Taxes and the officers administering the income tax law to provisionally attach any asset or property of the assessee in order to safeguard the interest of the income tax department. Then we have some miscellaneous provisions, section 282, 283, 284, which deals with service of notice. What are the ways in which the department can serve the notice? Section 282A, authentication of notices and other document. Section 292BB, which deals with which provides that no notice shall be deemed to be invalid immediately on account of certain situations. Or, for example, the section says that if there is any kind of typo error in the notice, then the notice will not be treated as an invalid for the purpose of income tax law. And then we have certain other miscellaneous provisions. We'll touch upon them as we move ahead. Largely, all these sections are procedural in nature and informative in nature, and we'll spend some time on each of those sections. Now, let us first start with section 269 SS. Now, this section is one of the important section so far as the exams are concerned, but also in the practical life. You all would have come across so far, those who have already undergone their internship in the audit profile, you would have seen that in the tax audit report, there's a clause 31, which asks the taxpayer to report the transactions which are violative of section 269 SS, and thereafter section 269T, and thereafter there is another section 269 ST, which was later on introduced. Now, what does this section say? Probably, I think practically most of you would have already gone through this section. So, but in any case, we'll touch upon and we'll see some of the basic and practical illustration as well. Let us read the section or the content of the section. Whatever is you can see on the screen, that is not the bare provision as such, but then the essential part of the provision has been provided for in the material in a user friendly manner or in a reader friendly manner. But in any case, we'll read the provision line by line. It says that no person shall take or accept any loan or deposit or a specified sum from any other person or depositor except by account pay check or account pay bank draft or by use of electronic clearing system through a bank account or through such other prescribed electronic mode. We'll pause here. It essentially says that you cannot take or accept any loan, deposit, or a specified sum. We'll see what that specified sum is from any other person except through prescribed mode. Now, what are those modes? Account pay check, account pay bank draft, or by use of electronic clearing system. So essentially it says that you can accept the loan or deposit provided it is taken through the banking channels. If you undertake the transaction of acceptance of loan or deposit through any mode other than those prescribed in section 269 SS, then that would be treated as a violation of section 269 SS. We'll see what are the consequences if we take that. But then it says that there are certain other conditions as well. You cannot accept except, as I mentioned, through account pay check, bank draft, or use of electronic clearing system if, now there is a threshold which is given. That threshold is 20,000. If the amount of loan, deposit, or specified sum, or the aggregate, now this needs to be highlighted, aggregate amount of such loan or deposit, or on the date of taking or accepting the loan or deposit or specified sum, any loan, deposit, or specified sum taken or accepted earlier by the same person from the depositor is remaining unpaid, whether repayment has fallen due or not, the amount or the aggregate amount remaining unpaid. And the third, the amount or the aggregate amount referred to in 1 and 2 above, together with the amount or aggregate amount referred to in 2, is 20,000 or more. So there are essentially 3 categories they have provided. The first says the exact transaction value or the aggregate of transaction value from the same person if it exceeds 20,000 or more. The second category says on the date on which you take the loan or accept the loan or a deposit or any specified sum, there is already some amount outstanding previously, and if you club it, then the additional amount that you are going to borrow, even if it is less than 20,000, but then taken together it exceeds 20,000 rupees, then that transaction will also be triggered by section 269 SS. And the third and the last one says the amount or the aggregate amount referred to in 1 together with the amount referred to in 2, it exceeds 20,000 or more. If all these conditions are satisfied, and if the amount or if the manner or mode of conducting the transaction is not through account pay check or draft or any electronic cash system. So for example, if you take it by cash, or if you take it by bearer check, or if you take it by any pay order which is not drawn on a bank, or any other mode which is not prescribed under the law, in that case, that and of course the transaction value exceeds 20,000, that would be violative of section 269 SS. If the transaction value is less than 20,000 and if it is in cash, it's all fine. It is not violating 269 SS. If the aggregate value of transaction, multiple transaction is less than 20,000, then also it is fine. There's no problem. Now the question arises, what do we mean by the term specified sum which is referred here? So far as loan or deposit is concerned, in a layman term or in a normal parlance, we understand the loan to be a loan and the deposit. But then what is the specified sum? Let us see how these terms have been defined. Now, loan or deposit is also defined, but then specified sum means any sum of money receivable, whether as an advance or otherwise, in relation to transfer of immovable property, whether or not the transfer takes place. So the law is very clear. If you take the consideration in the form of an advance or as a consideration or as an installment or by whatever name you call it, provided the amount that you received is in relation to transfer of an immovable property, then in that case, that sum would be treated as a specified sum. So if we just go back, section 269 SS will apply to any amount taken in the form of loan or deposit, but any amount which is in the nature of a specified sum. That means you are undertaking the transfer of an immovable property and you are receiving any consideration, whether it is an advance or not, doesn't matter if it is in the form of cash, section 269 SS would be attractive. Now the question comes, if we repay the amount later on, we take an advance and then repay the amount, would that be violative of section 269 SS? The answer is yes, as the section itself says, the meaning of specified sum, whether the advance is refunded or not, it is not to be considered. Then the higher threshold of 2 lakh is applicable in case of any deposit or loan where such deposit is accepted by a primary agricultural credit society or a primary cooperative agricultural and rural development bank from its member. Second, if a loan is taken from a primary agricultural credit society or a primary cooperative agricultural and rural development bank by its member. So it is both way. If the member is taking a loan or if the society is taking the loan, either way, you have to please make sure that here we are not talking about the cooperative society or any cooperative. It has to be the primary cooperative agricultural and rural development bank, primary agricultural credit society, PACS, as well as the primary cooperative agricultural and rural development bank. This higher threshold of 2 lakh is applicable only to both of these organizations, not to others, provided the transaction is happening from its member. If these societies or this bank undertakes a transaction with a third person who is not a member of this society or a bank, in that case, this higher threshold will not apply, which needs to be taken care of. Now, then there are certain exceptions when this provision doesn't apply at all. If the loan, deposit, or a specified sum taken or accepted from, or any loan or deposit taken from or accepted by the government, any banking company, any post office or saving bank, or any cooperative bank, any corporation which is established by the central, state, provincial, or any government company as defined by the Companies Act, or any institution which may be notified in the official gazette by the government. So these are the general exemption, but then largely these organizations would rarely undertake the transactions in the mode other than the banking channel. But in any way, these have been exempted from the applicability. But then there is one more interesting exemption provided. The last one is the cases where the persons involved in the transaction derive income only and only from the agriculture. And here it is a typographical error. The students may note that this or is to be read as and. So this is a typo here. If you read the bare law, it says and. So this exemption is available where the persons involved in the transaction derive the income only from agriculture and neither of them has any income chargeable to tax under the act. Agriculture income, as you all know, is exempt under section 10. both the person on the receiving end as well as on the paying end, both the persons derive the income from agriculture, and none of them have got any other income chargeable to tax under the Income Tax Act. If this is satisfied, in that case, that will be granted the in that situation, Section 269 SS would not be applicable. So if you see, when we were reading Section 269 SS, they said, section says, except by account pay check, account pay bank draft, or by use of electronic clearing system through a bank or through such other mode as may be prescribed. Now, what are the other modes? Now, with the evolving ways of making payment, the section has been amended from time to time, and the other modes of payment have also been prescribed to include the credit card, debit card, net banking, IMPS payment, UPI. We all use the UPI in through mobile, RTGS, NEFT, and Beam. Yes, interesting. Whether crypto and digital, the answer to that is no. If the payment is in the form of, for example, Mr. A taking loan from Mr. B, and the Mr. B is not making payment through banking channel, but instead a certain crypto asset is being transferred in the account of Mr. A, that will not be treated as an eligible mode of transaction for the purpose of 269 SS, and 269 SS would be attracted in this situation. So you need to ensure that any crypto transaction, if you come across when you are carrying out an audit, in that case, that needs to be reported under clause 31 of the income tax audit report, and this would be violative of section 269 SS. Now let us turn to some of the illustrations, because we have now largely understood the section. I'll just share the screen, a different screen, rather. Just give me a moment. Stop sharing, and I'll just turn to laptop for a while. Yes. So hope you are all able to see the screen. Can somebody text me if you are able to see the screen? Okay, all right. So the first question you all will have to answer. Please read question number 1. We'll just complete. Whether 269 SS would be attracted in this case? It's a rapid fire round. You'll have to answer it yourself. As we move with the question, we'll have the higher difficulty level. All right, right. The answer is yes, 269 SS attracted. Question 2. Mrs. J accepts a loan of 12,000 in cash from Mr. K and a deposit of 15,000 in cash from Mr. Z on the same day. Whether 269 SS is attracted? Anybody would like to attempt? Question number 2. I'm reading the question once again. Mrs. J is accepting a loan of 12,000 in cash from Mr. K and a deposit of 15,000 in cash from Mr. Z on the same day. The transaction is happening on the same day from two persons. Whether SS would be attracted? So I think there are two answers saying yes. So the correct answer is no. 269 SS is not attracted because the transaction is happening with two persons, Mr. K as well as Mr. Z, whereas the limit of 20,000 is applicable only when we are receiving the loan or deposit or a specified sum from a single person or a single entity. Here the transaction, the lenders are two in numbers. Third question. Mr. X wants to take a loan of 6,000, a deposit of 9,000, an advance of 7,000. So in total, it would be 15 plus 7, 22,000 from Mr. Y. but the nature of transaction is different. Loan of 6, deposit of 9, advance of 7. So tell me whether section SS would be attracted in this case. All right. SS would be attracted because, as you see in the section it was mentioned, we have to see the aggregate of the payments under all type of transaction. Question 4. Mr. X accepted a loan from Mr. Y on 1st June 23 by a crossed check of 19,000. On 15th April 24, Mr. X wants to take another loan from Mr. Y for rupees 2,000. The earlier loan is still remaining unpaid. Whether 269 SS would be attracted in this case. So I already have borrowed 19,000 and then I am doing the another borrowing. Correct, because the amount is to be seen in aggregate. Question 5. Question 5. Mr. P accepted a loan from ABC on 1st April 24. So you guys read section question number 5 and let me know the answer. Okay, so one answer is no. Okay, so there's one more answer. So there are two answers. One is saying no, another is saying yes. So let us read the question once again and try to apply the provision. Mr. P accepted a loan from ABC on 1st of April by an account paid check for rupees 10,000. So the first transaction is acceptance of loan of 10K to which SS is not attracted. The transaction is. Then he had repaid 3,000 in cash on 3rd August. So then on 3rd August, there is a repayment of 3,000, but in cash. On 25th of September, P takes another loan from ABC for rupees 15,000 in cash. So here you can see the balance amount remaining is 7K is the balance amount, and then I'm taking additional 15K in cash. So therefore, in aggregate, 7 plus 15, it is 22. We don't have to see that the earlier amount which is outstanding, it should be whether it was taken in cash or through check. That is not something we are concerned with. We just have to see and consider for the purpose of applicability of section 269 SS whether there is an amount outstanding or not. If the answer is yes and we are taking even a single rupee transaction subsequently, which results into an amount exceeding 20,000, 269 SS would be attracted. So in this case, the answer is yes, SS would be attracted. Let's go to another question. On 12th December 2021, Mr. F took a cash loan of 10,000 from Mr. G. So there is a cash transaction, but 269 SS is not attracted because it's a cash but less than 20,000, and accepted a further loan of 9,000 from Mr. G by an account pay check. So first transaction is in cash. The second transaction is through check. Whether SS is applicable in this case? Right. Now, interesting question. Whether share application money received by a company shall be considered as a loan or deposit if the company is issuing the shares and the shares have been issued, the consideration has been received through modes otherwise than by an account pay check, whether that would attract the provision of section 269 SS. Now, the identical question came up before Honorable Calcutta High Court in case of Vamshi Chemical Limited. What the court said, in case, these are the relevant observations of the court. In case of loan, it is ordinarily the duty of the debtor to seek the creditor and to repay the money according to the agreement. In other words, a loan grants temporary use of money or temporary accommodation on certain conditions. Loan is an act of advancing money by one person to another under an agreement by which the recipient of money agrees to repay the amount on agreed terms. In case of deposit, it is generally the duty of the depositor to go to the banker or to the depositee and make demand for it. The essence of deposit is that there must be a liability to return it to the party by whom or on whose behalf deposit has been accepted on fulfillment of certain conditions. Whereas the share application money is for participation in capital of the company, which is neither a loan nor a deposit. Once the share application money is neither a loan nor a deposit, the provisions of SS and even 269T will not attract in this case. This is a case where actually it was 269T which was the issue. Consequently, no penalty under 271D of the Act shall be attracted in this case. So the court said that share application money is neither a loan nor it is a deposit, and therefore the provisions shall not apply. So I just now go back to our chapter. Sure, I think the case studies or some of the illustrations which we have discussed now, we will upload it on the portal so that is available to everyone immediately after this session. Now let us discuss what is the consequence in case the amount is accepted otherwise than through the banking channel. Section 271D, it says that if a person takes or accepts a loan or deposit or specified sum in contravention of the provisions of section 269 SS, he shall be liable to pay by way of penalty a sum equal to the amount of loan, deposit, or the specified sum as may be, and any such penalty shall be imposed by the joint commissioner only. So normally the assessment is carried out by an assessing officer. When the assessing officer during the course of assessment, if he is observing that assessee is undertaking the transaction of SS and T, while he will conclude the assessment in the normal course. But so far as the imposition of penalty is concerned, he will mark his observations in the assessment order, but he cannot impose the penalty. If your assessing officer is not having the designation of joint commissioner, he will have to refer the matter to the joint commissioner of income tax. There would be a fresh proceeding and the joint commissioner would impose the penalty unless there are a bona fide cases where you can justify the reason for undertaking the transaction through a mode otherwise than by an account pay check or banking channel. Now let us discuss one more interesting section, section 269 ST, mode of undertaking transaction. It says that no person shall receive an amount of 2 lakh or more except by account pay check or account pay bank draft or by use of electronic clearing system through a bank account or through such other prescribed electronic mode. So largely the language is similar to section 269 SS, except the amount here mentioned it is 2 lakh. Second, it doesn't talk about a loan, deposit or a specified sum. It merely says the person shall not receive an amount of 2 lakh or more except by account, paycheck or banking channel. Collectively, we'll call them as a banking channel. So a person is defined to include everybody: individual, HUF, company, AOP, BOI, artificial juridical person, or even a trust. So all categories of person shall not receive an amount of 2 lakh or more except through the banking channel. Now, there are certain conditions. If in aggregate, okay, so the amount of 2 lakh, how we need to check it? There are three aspects or limbs to it. One, you have to see it in aggregate from a person in a day. So from in a single day, from a single person, if you receive amount of more than 2 lakh, let's say in cash or through any other mode, in that case, that would trigger section 269 ST. You have to see the amount in aggregate. So say for example, from a same person on a same day, if you receive the amount less than 2 lakh, which in aggregate makes up more than 2 lakh, that will also trigger section 269 ST. Secondly, in respect of a single transaction. Now it says that if a single transaction, for example, you make a sales of 5 lakh to a person, that person on a day one, he pays you X amount, on day two, he pays you Y amount in cash. In aggregate, all these transactions or receipts relate to a single transaction of sale. If they make up INR 2 lakh, in that case, that would be treated as violation of section 269 ST, even if it is received on different dates. The third, if it is in respect of a transactions relating to only one event or occasion from a person. Then there are certain circulars which provide some relaxations from the rigors of the provision. Like for example, some exceptions have been carved out for NBFCs and housing finance company. CBDT has issued a circular number 22 of 2017, wherein it has clarified that if the amount is received by NBFC or housing finance company and the nature of receipt is a repayment of a loan, the receipt of one installment of loan, the receipt of one installment of loan repayment in respect of a loan, it will constitute only a single transaction, which is specified in 269 ST, and all installments paid for a loan, they will not be aggregated for the purpose of determining the applicability. When the section is not applicable, any receipt by a government, so it is again similar to what we discussed in section 269 SS, largely any receipt by government, banking company, post office, or any transaction in the nature of 269 SS, or any notified transaction or a class of person or class of receipt, that would be excluded. Nothing has been, I think, okay. So we'll now, okay, yeah, this is important. So there's a notification number 28 of 2017 and 57 of 2017, wherein the central government has notified that the provisions shall not apply to particular categories of transaction. For example, if there is a receipt of cash or there are cash withdrawal by a person from a bank, cooperative bank, or a post office saving bank. Now, if you see the bare provision, it looks that these transactions would also get covered under 269 ST. But then the government felt the need to carve out an exception for these transactions, and this notification was specifically addressed to the transaction of cash withdrawal. Second, if there is a receipt by a banking or a business correspondent on behalf of a banking company. Third, receipt by a white labor automated teller machine operated from retail outlet sources on behalf of a banking company, again relating to banking. Receipt by an agent, receipt from an agent by an issuer of prepaid payment instrument, receipt by a company issuing credit cards, or receipt which is not includable in the total income under section 1017 capital A. Penalty. So if a person is contravening the provisions of section 269 ST, he shall be liable to pay a penalty, a sum equal to the amount of such receipt. So exactly same as section 269 SS, the transaction value would be treated for the purpose of levy of penalty. The exact transaction value would be the amount of penalty. However, if you are able to justify that the transaction was undertaken in a good faith and you have got sufficient reasons for doing this contravention, then probably you may get away with the rigors of section 271 DA. Now we all know that the in remote villages where the agricultural activity is carried out, or even otherwise also in remote villages where non-agricultural activity may also be carried out, there may not be the banking facility. Take, for example, the case of COVID-19. Now, during COVID time, where almost all the operations, there was a complete lockdown. In those situations, if a transaction is undertaken in a cash, and then there is a clear-cut violation of section 269 SS or 269 ST or T. In that case, there would be a bona fide situation because one, I could not have undertaken a transaction through banking channel. Say, for example, I am not a person who uses the net banking. I may be issuing the checks, but then I was not in a situation where I can issue the check. So I undertook the transaction in cash. In that case, a good bona fide reason has been made out, a case has been made out, and therefore penalty under 269, 271 DA for an offense committed under section 269 ST may not be imposed. There is one interesting circular which CBDT has issued in the context of section 48.3, section 269 ST, and rule 11, 114B. Now, what does it say? Says that the provisions of section 48.3. Now, we all know that if you make a payment and it is in the form of an expenditure incurred and the amount of payment exceeds 10,000, then if it is in cash, then section 48.3 specifically says that you need to disallow the expenditure because the payment has been made in cash. Now, rule 6DD that provided an exception to the applicability of section 48.3 in certain specified situation and circumstances. This was always there even prior to 2017 because section 269 ST was not there at that point of time. Now, this rule 6DD provided that the disallowance will not be attracted provided the payment is made for purchase of agricultural produce and payment is made to the cultivator of such cultivators of such agricultural produce, and therefore no disallowance would be attracted under 48.3. That is what it was already there. Now, once section 269 ST comes into play, the section says that if you receive the amount in excess of 2 lakh rupees in cash, then the entire transaction value would be subject to the penalty proceeding and you would be impose the penalty of an equal amount. Then there was a conflict because section 40A, 40 capital A in subsection 3 says that if you make a payment exceeding 10,000 rupees, then the expense will not be disallowed. But rule 6DD, that gives you an exemption. It says that if the transaction is of a specified nature, what is that nature? That the payment is made for purchase of agricultural produce and it is made to the cultivator of such producer. In that case, the relaxation would be provided from the applicability of section 48.3. But then this section came wherein it says that we'll impose the penalty. So while at the one hand, there was an exemption from disallowance under 48.3, on the other side, section 269 ST imposes a penalty. So CBDT has come out with certain relaxation, wherein it says that provisions relating to quoting of PAN or furnishing of Form 60 under Rule 114B, it will not apply to the sale transaction if the transaction value is 2 lakh or more. And this is what the CBDT has clarified. You can read A, B, and C. Provided the transaction value is less than 10 lakh, 2 lakh. So this is all about section 269 ST. Now, one question for students, whether the transaction is of a revenue account or it is of a capital account. Would that make sense so far as applicability of 269 ST is concerned? Say, for example, I'm selling goods. I'm earning revenue out of it. If I collect the cash and the transaction value is in excess of 2 lakh rupees, then section 269 ST comes into play. But then if I undertake a transaction which is in the nature of a capital nature, for example, accepting, as we discussed previously, share application money in cash. Now, share application money is neither a loan, nor it is a deposit, nor it was a specified sum under section 269 SS. But would section 269 ST be applicable if I undertake the same transaction of receipt of share application money? Just read the provision and let me know your thoughts. Should I repeat the question? So the question is, when we were discussing section 269 SS, that section said that no person shall accept loan, deposit, or a specified sum. Specified sum was defined to mean the transaction or a consideration in respect of transfer of an immovable property. If the amount of consideration or the amount of money received in cash is towards the issuance of share application money, receipt of share application money, then we discussed the case law also, wherein the Calcutta High Court said that 269 SS is not applicable. Now the question comes, whether on the same transaction of issuance of share capital or receipt of money towards share application, whether section 269 ST would be attracted. Assume for the time being the transaction value is more than 2 lakh rupees and the amount received is in cash, otherwise than through the banking channel. If you say yes, you have to give the reason. If you say no, you also have to give the reason why no. So if you read the language, section 269, it is very easy. The section says, no person shall receive an amount of 2 lakh or more except by account pay check or by account pay draft or use of electronic. Exactly, right. So someone has rightly mentioned, yes, section ST would be applicable because the section nowhere says that it should relate to loan or nowhere it says it relates to deposit or a specified sum. It's an open-ended section. It applies to all transactions, whether transaction is in the revenue nature, capital nature, whatsoever the transaction nature is. If the transaction value is more than 2 lakh, it is in aggregate from a person in a single day in respect of a single transaction or in respect of a single event or occasion. Only these are the conditions you have to look for. If any of these conditions are satisfied, 269 ST will come into picture. Now let us move to some of the other provisions. Facility for accepting payment through prescribed electronic mode. Now, I call this section a very funny section because the section was introduced for some purpose, but the implementation is happening in some other area. You yourself would vouch for my statement as we read it. What was the intent? The intent of the government has been, as we all know, to reduce or sort of demotivate the cash economy and to promote the digital economy. I mean to say, to promote the transaction through the banking channel or through the digital mode, so that all the transactions are within the purview of the government and they can be traced and there is no black money in the system. That has always been the objective. And gradually the governments have been introducing various measures to promote the cashless economy. That has been the objective. Section 269 SU was introduced with effect from 1st November 2019. Now, to whom does it apply? The section applies to every person carrying on the business will provide facility for accepting payment through the prescribed electronic modes in addition to the facility of other electronic modes of payment, if any, being provided by the person. The condition is if his total sales turnover gross receipts in the business exceeds 50 crore during the immediately preceding previous year. Now, what are those prescribed electronic modes? Now, those prescribed electronic modes are given in Rule 119AA, which says debit card powered by RuPay, UPI, Beam UPI, or UPI QR code. Now, if you see the threshold and the coverage, it says your turnover, sales, or aggregate amount of gross receipts should exceed 50 crore during the immediately preceding previous year. That means here we are not talking about the small taxpayers. We are only talking about the large taxpayers. 50 crore and more should be the turnover. Then these are the modes through which you have to receive the payment. That means you have to make these arrangements. Like for example, if you run a factory or if you are a service provider, your turnover in the previous year is more than 50 crore, then this section is applicable to you. You have to keep a scanner, QR scanner code outside of your factory, outside of your offices, so that the payment can be received as a facility you have to provide. But then CBDT came out with a circular which says that circular number 2012, circular number 12 of 2020, what does it say? Clarifies that provisions of 269 SU shall not apply to a specified person having only B2B transaction, that is, no transaction with retail customer or consumer, if at least 95% of the aggregate amount received during the year, including amount received for sales turnover, are by any mode other than cash. So as we read earlier, the section mandates that if your turnover is more than 50 crore in the previous year, you have to give the additional facility to your customers, to your suppliers, that you can make the payment through the electronic mode to me. But then circular says that provisions will not be applicable to those specified person who are only having B2B transaction, and if at least 95% of the aggregate of all amount received are through any mode other than cash. Look at the reality. The QR or a scanner code largely would be found at the places like Kirana store or small store where, or even the tea vendors, they were the early adopters of Section 269 SU, which was actually not applicable to them. They proactively implemented it. But those organizations which are large in size, like having a turnover of 50 crore or more, what is the need of introducing Section 269 SU? Because largely the transactions are undertaken through the banking channel. Why I say so? If I'm a large organization, how inconvenient practically it becomes that if somebody wants to make a payment of 5 lakhs to me, he'll come to my store and he'll say, okay, I'm not going to pay in cash, give me the QR code, I'll scan through it. So largely the transactions are undertaken through the banking channel only. But in any case, the government ideally should have brought in this provision for the person whose turnover does not exceed 50 crore. But the provision has been made mandatory for the person whose turnover exceeds 50 crore. Just 1 second, you read this provision. I'll be back in few seconds. Now, what is the penalty for non-compliance? In order to ensure the compliance of provision of this section 269 SU, there is a penal provision also. It says that if you fail to comply with 269 SU, that means if an organization having a turnover exceeding 50 crore, if it does not have prescribed arrangement, like for example, it has not provided these facility to its customer, unified payment interface, quick response code, UPI QR code. In that case, there is a penalty of 5,000 per day till the time the default continues. Now let us discuss, because there are many provisions to be covered today. We'll touch upon these informative provisions, each of these provisions briefly, because right now we are on page 8 and we have to reach page 49 to cover everything for today. So we'll expedite a little bit on some other provision. 269T. Now, this is the last provision in the series of provision relating to 269 SST, ST, and then finally T, which is the repayment. We understood the provisions of 269 SS. 269T is largely the opposite of 269 S. That means it deals with the repayment of loan, deposit, or a specified sum. But then that section was applicable to all kinds of persons, all category of person, whereas 269T is applicable also to the branch of a banking company or a cooperative bank or any other company or a cooperative society. And then it says it also includes or applicable to the firm or other person. What does the section says? The section says that these specified persons, they shall repay the loan or deposit or any amount of specified advance received by it otherwise through the banking channel. If the repayment is in cash or through crypto payment or through any other mode, then the penalty provisions would be attracted. Section 269T on the lines of 269 SS, it says penalty would be of equal amount. The provisions are largely worded on the similar line, that is the amount of loan, deposit, specified advance, but then you also have to consider the interest amount, if any, payable thereon. Second, the aggregate amount of loan deposit held by such person with a branch of a banking company or a bank, cooperative bank, or the other company or society, etc., in his name or jointly with any other person on the date of repayment together with the interest. Third, the aggregate amount of specified advance received by such person either in his own name or jointly with any other person on the date of such repayment if the amount exceeds 20,000 or more. Please make sure that when you calculate the applicability of 269T, for the purpose of applicability of 269T, when you calculate the amount of repayment, the first limb is similar to section 269 SS. You have to see the transaction value. Second, you have to see the transaction value and what was the opening balance. And the third, you have to aggregate the value under both these limbs. And while calculating the transaction value, you will have to see what was the interest that was outstanding previously. Again, on the lines of section 269 SS, here also the similar exemption or the higher threshold has been prescribed for the primary agricultural credit society or a primary cooperative agricultural rural development bank. PACS and PCARD, the limit of 20,000 will be enhanced to INR 2 lakh. But please make sure when this higher threshold is applicable, only when the transaction is between the member and the cooperative society or vice versa. It is not applicable when this agricultural credit society is dealing with a non-member taxpayer or assessee. Likewise, the section is not applicable where the repayment is made by a branch of a bank or a cooperative bank, or such repayment could be made by crediting the amount of such loan to the savings bank account. Provisions will not be applicable where the transacting parties are government, banks, corporation established under any statute or by central or state government. Any government company as defined in Section 617 of the Erstwhile Companies Act 1956, or the class of person that may be notified. So these are general categories of sort of assessees or persons who have been excluded from the purview of Section 269T. What do we mean by the term loan or deposit, which is repayable after notice or repayable after a period? In case of any person, as we read the decision of Calcutta High Court previously, the loan or deposit, the common characteristic is it is a liability which is repayable. Specified advance, any sum of money in the nature of advance, same exact ditto definition. By whatever name you call it, it is in relation to transfer of an immovable property, whether or not the transfer takes place. Penalty under Section 271 capitally, same. If there is a violation of Section 269T, the amount of penalty would be equal to the amount of transaction. Now with this, we complete the first phase of our sort of this chapter, miscellaneous provisions. We discussed Section 269 SS, which prohibits the acceptance of loan, deposit or specified advance or specified sum exceeding 20,000 from a person in a day or in certain situation. We covered Section 269, which deals with the repayment of the loan, deposit or specified advance. And we also covered Section 269 ST, which provides a broader definition and a higher threshold of 2 lakh and covers all kinds of transaction to discourage the cash transaction. And we also discussed Section 269 SU, wherein they said that the specified class of persons will have to make sure that they provide the facility of payment through RuPay card or through UPI scanners if the transaction value of, if the assessee is having a turnover of more than 50 crore in the preceding financial year. But then there are certain circular issued by CBDT wherein they said that B2B transaction will be excluded, provided the 95% of the transactions have been undertaken in the previous year through the banking channel. This is what we have discussed so far. Now we'll turn upon the another part of the provision, the second part, Section 281. Again, a very old section in this statute. What does the section says? The section basically empowers the government to declare, or even rather the revenue department to declare any transfer of a property or an asset which is to defraud the revenue. The revenue here would mean the income tax department as void. If you are undertaking a transfer, there are largely the transaction would be governed by the two laws. One is the Contract Act and another would be Transfer of Property Act. Let's say you satisfied all the conditions of a Contract Act. You undertook a transfer with a sound person. The transfer of an asset was for adequate consideration. There is a contract in place. Everything is there. But even in that case, the government can say that we do not recognize this transfer of asset because the transfer has been within the purview of Section 281. Largely, this section was basically to ensure the interest of revenue is protected. Take the example of Kingfisher Airline, for example, for simplicity's sake, or any airline company. This is an airline company which is incurring a lot of losses. It is not able to pay to its creditors. It is not able to pay to its employees. In those situations, there is in all probability a chance that the company might go for liquidation, or there may be a possibility that company may have done some non-compliances. Now the company is facing the scrutiny assessment under the income tax law. In all likelihood, there may be chance that, let's assume there's going to be a tax demand on the company. But the demand is not yet crystallized because assessment proceedings are ongoing. While the proceedings are ongoing, the company had undertaken the transaction whereby it has sold off majority of its assets. Now the assessment is completed. Once the assessment is completed, the tax officer issues the demand notice and he says that you have to pay the X amount. But the company says that, look, I'm a private limited company or I'm a limited company. My liability is limited to the extent of my share capital. I have already disposed of all my assets. I have nothing to pay. You cannot lift the corporate veil because the company is a private limited company. Its capital and liability is limited to the extent of its share capital. Now, in this situation, what happens? Many times the objective could be to defraud the revenue because there would be a likelihood of demand coming up. So if I dispose of the asset, in that situation, I may be safeguarded from making payment of any kind of income tax. So the section says that as a safeguard against non-realization of revenue due to fraudulent transferring of asset by a defaulting assessee. What is important to note here is the fraudulent transferring of assets. So if on the facts, it can be established that the transfer which was undertaken was a fraudulent transfer. What do we mean by fraudulent? Something which has a bad or a malified intention. The transaction which is not a bona fide transaction. The transaction which usually may not have occurred except because there was a likelihood of tax demand. All these transactions would be treated as fraudulent transaction. In that situation, those transfers are deemed to be void for the purpose of income tax. The Act says, Section 281 says, that we don't recognize this transfer. So what happens? We'll assume that the asset is not yet transferred to the transferee. It is still owned by the transferor, and the department has a right to recover its tax demand from the transferor by either attaching the property or by disposing of the property in the manner in which it wants. But there are certain conditions. In case where during the pendency of any proceeding under the Act or even after completion thereof, the most important condition is there should be the pendency of any proceeding. When I say any proceeding, that means not only the assessment, it could be appeal proceeding, it could be penalty proceedings, any kind of income tax proceeding under the Income Tax Act would be covered here. Or even if the proceeding is not pending, the proceedings have been completed even thereafter, but before service of the notice by the tax recovery officer. So practically what happens, the assessing officer will carry out the assessment. He will pass an assessment order based on the time limits. Once the assessment order is passed, if there are any kind of additions, then the demand is raised on the assessee. The notice of demand under section 156 is served on the assessee. If the assessee wants to challenge the notice of demand, he will have to file an appeal by making such a prescribed amount of pre-deposit, which is 20% under the circular. He'll make a deposit. Balance, he may be stayed or it may not be stayed. If the amount is not stayed, there's no stay petition filed or the department doesn't grant stay against the demand, then department will ensure that the recovery is undertaken. Usually, it is the assessing officer which will issue the tax notice for recovery of the demand. But in that case, the department has created a special wing, and there is a specific set of people called tax recovery officers. Those TROs are transferred the cases where there's a large recovery of tax demand from the assessee, and they undertake an independent procedure of recovery of taxes. So the law says that in case where the assessment is pending or any kind of proceeding is pending under the Act, or the proceeding is completed, but there is no notice which is served by the tax recovery officer. In that case, if the assessee is creating a charge or parts with the property by way of sale, mortgage, gift, exchange, or any other mode. So a very open-ended line. Even if you create a charge against the property, even that charge will be treated as a void. For example, I'm an owner of immovable property. By pledging it with the bank, I take a loan. In that case, even that charge created, even though it has satisfied all the conditions, it will be disregarded for the purpose of income tax law, and officer will still have a right, provided the charge has been created during the pendency of proceeding or after completion of proceeding, but before receipt of service of notice by the tax recovery officer. Such charge must be deemed to be void as against any claim in respect of tax, penalty, interest, fine payable by assessee as a result of completion of the proceeding or even otherwise. Now, please note that this section is applicable to all cases where the tax amount payable or likely to be payable is 5,000 rupees or more, and the assets which are charged or transferred by the assessee exceeds 10,000. Now, practically, this value which is prescribed is quite immaterial, but in any case, this is the law as on that date, as on today. The charge or transfer made by the assessee, in two circumstances, it will not be treated as void. First, if the transaction has been undertaken for an adequate consideration and without any notice of the pendency of such proceedings, or without any notice of such tax or such money remaining payable by the assessee. Say, for example, in my case, I own an immovable property. I filed a return for a particular year. After 4 year or 5 year, the department issued the notice under section 148 capital A for doing the reassessment in my case. Now, let's say I'm not aware that the notice has been issued and it is there on the income tax portal. Neither I am aware nor my authorized representative are aware. In the meantime, while the proceedings are ongoing because notice has been validly issued, I transfer an asset for an adequate consideration. Can the department question that transaction? The answer is no. Why? Because the transaction has been undertaken with consideration and I'm not aware, I'm genuinely not aware about the pendency of proceeding. And likewise, if I'm not aware of any kind of demand which is payable by me, then the transfer cannot be declared as a void. Second situation, I am aware of all the proceedings, I am aware of the tax demand, but in any case, I have specifically sought an approval from the assessing officer to part with my asset or to create a charge or to completely dispose of the asset in whatever way I want. In that case also, section is not applicable. Now, please note that, let's say, this section is very wide. It can make or it can declare any transaction as void. But then there are certain restrictions. As we discussed, there are two situations, but over and above that, if I am owning a particular asset as a stock in trade, I do not recognize it as an immovable property or not as an investment or as a property, but it is a stock in trade. That means I am into the business of dealing into those assets. In that situation, that is an exception that department cannot treat the transaction as void if the transaction is undertaken in the ordinary course of my business and the asset is classified as a stock in trade. Now there is one connected to this section only. There is section 281 capital B. Just read the provision. You will easily understand because when you understood section 281, 281B would be quite relevant to it. Once you read it, then we'll discuss it. Just let me know once you are done. If it is completely clear, or do you feel there is any need to discuss? The section is very self-explanatory. Almost majority of the section now, as we will go through, those are very self-explanatory, but we'll touch upon some of the important aspects. So at time, what happens that, let's say a search and survey operations are carried out under the Income Tax Act. Now, during the course of search and survey, the assessing officer observes that there's a lot of unaccounted income, and once the search is completed, the assessment is immediately initiated. And during the course of assessment, while it takes a long time, several months together to finalize the assessment, the department feels that assessee may either part with the value of property, or he may, if the property is, let's say, in the possession of the assessee, or through any other manner, there may be some fraudulent activity that might take place. Now, again, to ensure and to protect the interest of revenue, the assessing officer would usually make a provisional attachment. Say, for example, there's a bank balance. While the assessment is carried out, assessing officer might inform to the bank that there is a provisional attachment on this bank balance, or there are fixed deposit, or even certain assets, valuable assets, are kept in the bank locker. Practically, under the GST law, those who have uh, filed the GST returns quite often would have observed that the clients often reach out to us that their bank account has been freezed, or that has been sort of attached by the GST officers. This is usually to protect the interest of revenue, that if you fail to comply with the law, or if there is a likelihood of demand coming up, then department often takes this step and they provisionally attach your property. It can be immovable property, movable property, or a bank account, provided the approval is obtained from the officer higher in rank, as you can see. What is the validity of provisional? Now, as the word suggests, it is not a permanent attachment. It is not a recovery. There is no crystallization of liability yet. It is a provisional attachment because there is a likelihood of demand, or there is a likelihood of assessee escaping from making payment of demand. Now, that provisional attachment once made, it will be valid for a period of 6 months from the date of order. But then the officers higher in rank, like chief commissioner, principal commissioner, director, they have been authorized to extend the period of provisional attachment. And but then if they are extending it, they have to record it in writing, and they have to give you an opportunity of being heard. In all, the total period of extension will not exceed in any situation the 2 years or 60 days after the date of assessment, whichever is later. So that is the validity of provisional attachment. There was interesting recommendation by Justice R.V. Iswar, retired judge, under whose chairmanship the recommendation was made that whenever the department wants to attach a property, a facility may be made to the assessee that instead of property, if the assessee provides certain guarantees, in that case, the property may not be attached. Take, for example, if my bank account, which is a current account, or any kind of facility is attached by the tax officer, what will be the impact? While the assessment will continue for next 1 or 2 years, in the meantime, assessee may not be able to carry on the business in a peaceful manner. I have to make payment to my vendors. I have to receive some money from my customers. I have to make payment to my employees. So all these payments would be halted, and in result, there would be a lot of suffering on other sides. And therefore, the committee made a recommendation. Okay, in case there is a likelihood of any demand coming up and you wish to provisionally attach the property, make an arrangement, let the assessee come up with a bank guarantee or any other kind of financial guarantee, which should ideally be accepted as a valid form of, so to say, the assurance that the assessee would not escape the uh, obligations under the law. So therefore, section 281 capital B subsection 3 to 9, they provide for the option of furnishing of bank guarantee in lieu of provisional attachment of the property. So if the officer contemplates to provisionally attach the property, he might issue the show cause notice and he may make an arrangement with the assessee that you provide the bank guarantee. Now, what is bank guarantee? Bank guarantee is nothing but you reach out to your bank and the bank on your behalf will provide the guarantee to the tax department that in case of failure on the part of assessee to make a payment of demand at a future date, it is the bank's obligation that bank will make the payment. What will happen? You will get a complete peace of mind. You carry on with your business or your routine activity. You have already given an assurance to the tax officer through a bank guarantee. And that will, of course, entail some cost for you. But then, in any case, that has its own benefits. Bank guarantee in lieu of a provisional attachment. Reference to valuation officer. Now, when you provide a bank guarantee, it should not be less than the fair market value of the provisionally attached property that needs to be ensured. Reference to valuation officer. Now, in case the property is under attachment, the officer might refer to the valuation officer the entire matter before attaching the property. I might have 100 properties. You can't attach all the properties because as a tax officer, I would not know what is the value of the property. And I'm at least make a guess that this is going to be the amount of demand. So what will happen? He will refer the valuation of asset or a property to the valuation office. He'll come out with a valuation through a scientific and a practical methodology. And then to the extent of valuation, he will attach the property provisionally. Now, as we mentioned earlier, the property or this is a provisional attachment of a property. This is not a permanent attachment or kind of a season. So there is a time limit which is provided. Earlier we discussed the time limit is 6 months and it can be extended up to 2 years with the prior approval of the chief commissioner. But then it says that you also have to revoke the attachment of the property in lieu of bank guarantee, but that also has to happen in a time-bound manner. So therefore, the order revoking the attachment, it has to be made by the officer within the following period. In case where the reference is made to the valuation officer, you get an extra 30 days. So 45 days from the date of receipt of such guarantee. In case of any other situation, within 15 days from the date of receipt of guarantee, you will have to revoke the attachment. Now, we discuss the revocation, but then when can the bank guarantee be invoked? Now, first, let us understand what do you mean by the term invocation or invoking the bank guarantee. This is a case where the assessee fails to take the payment of demand. The assessing officer will issue a notice to the bank or the person who has provided the guarantee. Usually, it is the banks only which provide the bank guarantee that this much amount is due from the assessee, and the officer will direct the bank to make the payment of demand on behalf of assessee in case since the assessee has failed. That is called as the invocation of the bank guarantee. Now, power guarantee on assessee's failure to renew or furnish the new guarantee. In case the assessee fails to renew the, because bank guarantee will also have its tenure. Bank cannot give an assurance for an indefinite period of time. Usually it is 6 months to 1 year, or it makes it could be 2 years. And in case you fail to honor your obligation, or if the assessment continues for a prolonged period of time, in that case, you either have to renew the bank guarantee or you furnish a new guarantee. If you fail to do so, then again the tax officer has got a right to invoke the bank guarantee. Now, what is the manner of realization? When I invoke the bank guarantee, how do I set off the amount which I received as a tax officer from the bank? The realization has to be first adjusted against the existing demand. The additional amount remaining after the adjustment, it will have to be deposited with a specified bank account maintained by the Commissioner with the Reserve Bank of India. Release. Where the AO is satisfied that the guarantee is no more required, he will have to release the bank guarantee forthwith, that means immediate. Now let us discuss the service of notice of demand, and then we take a break of 10 or 12 minutes, whatever is the period that is there. Section 282, 283, and 284. What are the permissible modes of service of notice? So, have you ever handled practically any kind of assessment or appeal proceedings? Anybody from you? Would you like to share what are the prerequisites when you receive a tax notice? If you are a chartered accountant, when you receive a tax notice, before you read the content of the notice, what is it that you look at? Any practical idea? Tomorrow you will be a chartered accountant, and clients will definitely reach out to you. Okay, sir, here is a notice. How do I respond to it? Would you just take up a notice and see what is asked and submit the reply, or what is it that you would look at the notice, or what questions will you ask to the client? Anybody would like to take a opportunity? Of course, it is not part of syllabus, but then we have to discuss some practical questions to understand the rationale why this provision is there under the law.
Sir, first, if there is some notice arrives to our client, then we will first read the notice and also know about whether it is, what is the notice related, and we will discuss about the notice with the client also, and provide the explanation regarding the notice, and get some proper reasoning with the client.
Right.
And then we if and the period which is mentioned in the notice for response, we will, after gathering all the information from the client, then
Right.
with the consent of the client and all the information, we will respond to the income tax.
Right. So good attempt, Jenny. So as you rightly mentioned, when we are receiving the notice, the first I'll just share some additional points over and above what Jenny mentioned. So the first and foremost is when you receive a tax, when your client receives a notice, some of the general pointers or indicators would be first to confirm and check, yes, it has been issued by the tax department only. How do you know? That you can know through certain specified rules and regulations that have been prescribed. For example, section 282 to 284 that provides the manner of service of notice, how the notice needs to be served. Can a tax officer personally come to the client's home or office and say that, oh, look here, this is a notice, you have to file a response to it by tomorrow or by day after or by a specified period of time? Is this a manner of serving the notice, or is this the valid way of serving the notice, that section 282 to 284. So the first question naturally we ask to the client, how did you receive the notice? Then when we look at the notice, we see what is, before getting into the content of the notice, whether the notice is signed or not. If it is signed, by whom it is signed, and whether the signature is valid. Then we see the jurisdiction. Who has issued the notice? The person who has issued the notice or the officer who has issued the notice, is he my assessing officer? Whether it is issued by the jurisdictional officer or it is issued by a non-jurisdictional officer. So all these questions will come in your mind, and they should come in your mind, because before you get into the content and reply to that content, first you have to familiarize yourself that there are certain statutory provisions in the income tax law which are to be adhered to by the tax department also. And if the tax department does not follow those provisions, then that makes the notice as well as the proceeding invalid in the eyes of law. So one such provision is the service of notice. What are the permissible modes of service of notice? So in our example, as I mentioned, the tax officer cannot hand over the notice to me personally. It has to be through the specified modes of service of notice. For example, it could be by way of post or such courier service as are approved by the CBDT in the manner as provided in the Code of Civil Procedure, in the form of an electronic record as provided in Chapter 4 of the ICAI, or by any other means of transmission as may be notified by the CBDT. Rules to provide for addresses for communication. Addressing in case of different assessees. Now, in case you are a partnership firm, the addressee can be any member of the firm. In case of HUF, either the manager or any adult member of the family. In case of company, local authority, or AOP BOI, it is the principal officer of these organizations. Individual, it is the individual himself who will be the addressee. In case of any other person in charge of the management or control of its affair. Take the case of, let's say, for example, I am the assessing officer of Reliance Industries Limited. Reliance employs more than 1 lakh people under its organization. Can I hand over the notice either electronically or through an email? I am a tax officer. I am the jurisdictional officer. Can I hand it over to any of the employee of the Reliance and I say that, okay, look, I have sent you the notice. Now please reply to it. Answer is no. You also have to ensure that you address it properly to the correct addressee. In case of company, it has to be the principal officer. In case of an individual, can a tax officer send a notice to my neighbor? Answer is no. It has to be me. Can he send the notice to my employee and addressing it to me? Answer is no. It has to be addressed to me and it has to be sent to me at my address. In case the firm is not in existence, a dissolved firm, to whom can we serve the notice? Any adult person who was a partner immediately before the dissolution. Now, many a times students think that these all provisions, I'm just going off topic, these all provisions, which are the procedural provisions towards the end of the Income Tax Act, like last provision, section 280 and all series, these are of not much importance. But please mind well that while these sections have been kept towards the end of the Income Tax Act, when you actually practice the income tax law as a chartered accountant, these sections hold the great importance, rather the greatest importance, because they all go to the root of the matter. You can ideally, if there is any kind of sort of non-compliance by the tax department to any of these provisions, that will make the entire assessment, appeal, or whatever may be the proceedings going on as a void assessment in the eyes of law, and we can get a favor for our client, provided we know these provisions. Usually, I have seen that the article students, when they see the notice, they usually overlook these provisions and they start writing or start typing the response against the notice as to what was asked. But now if you see the importance of these provisions, if the way of serving the notice is also not complied with, that makes the assessment invalid, and you can actually put a legal submission that this is not a valid service of notice. Coming back to the topic, in case of a partitioned HUF, the last manager of the family. In case of a dissolved association of persons, any person who was a member immediately before dissolution. In case the business of an assessee is discontinued, then the assessee himself. In case of firm, the previous member or a partner, as the case may be. In case of a company, it's principal officer. So this is the manner in which, yes, someone is asking serving notice on WhatsApp. Can it be allowed? Now, as we discussed, the manner of serving the notice, it has to be by post or courier, or in such manner as provided in Code of Civil Procedure Code. Third, in the form of any electronic record as provided in Chapter 4 of the IT Act, and by any other means of transmission as may be provided by rules made by the CBDT. Now, if you read the rules also, I'm not sure it is there in the, it is not there, but if you read the rule says that it has to be through an email, nowhere it recognizes WhatsApp as a valid form of communication. Notice would come only an email, and right now even email is just an intimation that you have received a notice. The notice actually gets uploaded on the website on your income tax login portal. Once you log into the portal, you go to the My Proceedings tab, and then you will see that the notice has been issued to you. The moment notice is uploaded by the tax officer on the portal, on the immediate moment, the notice is reflected against your profile at your dashboard or My Proceeding dashboard. That is a valid service of notice. Email is just an intimation that you have received a notice. Please look for the appropriate response. So with the technological advancement, they have made it in this manner. E-proceeding tab. Yes, that's right. Authentication of notice and other document. Again, one of the most important aspect is the authentication. The notice has to be authenticated by the jurisdictional assessing officer. It should be signed, and it should be issued in a paper form or communicated in an electronic form. In accordance with the prescribed procedure. So can the tax officer copy paste the content of notice on a WhatsApp and send it to you? The answer is no. When I say electronic form, it has to be only in the prescribed electronic form. Please do not carried away by the fact that WhatsApp is also an electronic form. No, it is an electronic form, but it is not a prescribed electronic form. Authentication of notice. Electronic mail or electronic mail message. If the notice or other document is in the email body itself, then the name and office of the income tax authority is printed on the email body, and the email is issued from the designated email address of such income tax authority. So there has to be a valid email ID. If the notice is not in the body, but it is as an attachment in the email, it is sent as an attachment, then the name and office of the income tax authority is printed on the attachment also, and the email is issued from the designated email address. So these are the must to follow the condition on the part of assessing officer. So this is what we discussed about the electronic mail or electronic mail message. Then now we will touch upon an electronic record. If the notice or document is contained as a text or remark in the electronic record itself, then the name and office of the authority is displayed as a part of an electronic record, and such record is displayed on the designated website. If the notice is in the attachment, then again it is displayed on the designated website, and the name and office of such income tax authority is printed. So somebody has mentioned that the Supreme Court permits the serving of notice through WhatsApp. But I'm afraid if you can share with, for the benefit of all, the citation or what was the case law? Was it in the context of income tax or it was in the context of some different law? Because to my knowledge, under the income tax law, the WhatsApp may not be the permissible form of communication till as on date. So I think we are at 7:35. Let us take a 10 minutes break and then we resume on section 285B and the section onwards. Is it okay, Ashok ji? Okay, okay. Thank you. All right. Thank you. Yes. So now we'll discuss section 285 capital B. Now this section is just again a procedural section that requires certain specified persons to file an information in an electronic mode with the income tax department. Now, who are those persons? Section 285 capital B read with rule 121 capital A. It requires a producer of a cinema film or a person engaged in any specified activity. Now, what is that specified activity? Person engaged in specified activity or a producer of a cinema film. Earlier, it was only the producer of a film, but then the scope of this section was widened to include certain other categories of persons and activities within the purview of reporting. It says that within 60 days from the end of the financial year, you will have to file a specified form with the income tax department in an electronic manner. Now, what is it that needs to be reported? The manner of reporting, as I mentioned, it is in the electronic form. You have to report all the payments exceeding 50,000 in aggregate made to each person who is engaged by such specified person in such production or specified activity. So if I'm a producer of a movie, I make a lot of payments. I have to report all the payments which I have made, the payments which exceed INR 50,000 in aggregate. So if I have made multiple payments to the same person, but in aggregate, it comes to 50,000 or more. In that case, I have to report those transactions with the income tax department. What is the specified activity? Now, this has been expanded recently, wherein I think it was Finance Act 2020 or 2022, wherein they expanded the meaning of specified activity to even include the event management, documentary production, production of program for telecasting on television or over-the-top platform like OTP channels, which are like Disney Plus, Hotstar, Netflix. All those are the examples, or even the sports management event. I'm not sure how it is linked to other, but then gradually they are expanding the scope of reporting for all kinds of events or any kind of movies, documentary movies, or any production houses that operate. For them, the reporting obligation is going to be there. That if the amount of payment exceeds 50,000 rupees in aggregate to each of those persons, then you have to report. Just a simple section, not much to discuss or understand here. Obligation to furnish statement of financial transaction or reportable account. The most important, not only for exam but also from the practical point of view. Section 285 BA. You might have in your article sheet, you might have come across situation where you must have heard the term SFT reporting. Now, SFT reporting basically comes from this section 285 BA. Now, this reporting basically is carried out in the month of May, as it is a due date. In the month of May, we look at the accounts of the client and we see whether the client is required to file an SFT report, to whom it is applicable, and in respect of which transactions it is applicable. Now we'll discuss in detail. Now, what is the objective? First of all, before we get into the provision, what is the objective of this? So see, over a period of last 10 years, the department has been trying to collect as much information as possible. Say, for example, I'm an assessee. My income is less than basic exemption limit, but then I do a lot of transactions in cash. While I don't file the return of income because my income is less than exemption, but at the same time, I do a lot of cash transaction. I do a lot of investment. Naturally, a person who is having an income less than 2.5 or 3 lakhs, which is the basic exemption limit, cannot be expected to make an investment of 10 lakhs per annum. And the reason is very obvious. If he is making an investment, then previously the government was not aware. Why? Because there was no reporting mechanism. Like, for example, if I'm a company, I issue the shares to the shareholders. Now, issuance of shares, there is no tax. When I purchase the share, there is no income tax act that comes into picture. And largely, there were a lot of investments were being made and a lot of transactions were being undertaken when there was a suspicion that what was the source of such investment, what was the source of this transaction. Take, for example, my income is less than basic exemption limit, or I do not declare my income properly, but at the same time, I am organizing my wedding in some foreign destination where we spend a lot of money. I organize my destination wedding in Rajasthan, and it's a very sort of lot of spending has been undertaken. I have organized it through the event managers. There, the obligation has been cast, as you see in the previous section we discussed. Even the event management agencies are now required to report the transaction where they make the payment to specified person exceeding 50,000 rupees. But now under this section 285BA, the nature of activities, the class of activities or the class of persons, it has been expanding day after day. As per section 285BA, the following persons who are responsible for registering or maintaining the books of account or other document containing a record of any specified financial transaction or any reportable account under any law for the time being in force, they're required to furnish a statement. So following persons are required to furnish a statement. We are not talking about TDS here. TDS is different. That if you make a payment which is subject to TDS, then you file the statement of TDS in form 26Q, 27Q, 27EQ. All this is there, and that is without any conflict or any kind of contradiction to this section. This section is merely about the reporting requirement. What are the class of persons who are supposed to report? One is an assessee. Assessee means all kinds of assessee which are specified in the subsequent paragraphs. A person in the office of government, that means the government itself, local authority, then fourth is registrar or sub-registrar appointed under the Registration Act 1908, the registering authority empowered to register motor vehicle under the Motor Vehicle Act, the Postmaster General referred to in the Indian Post Act, the collector, the stock exchange, reserve bank, depositories, financial institution, or any other person other than as may be prescribed. Now, these are all the reporting entities. Which transaction are we required to report? The transaction of purchase, sale, exchange of goods, property, right, or interest in a property, a very open and wide-dated sort of scope. Any kind of service, any works contract, any investment, any expenditure, or transaction of taking or accepting any loan or deposit. So you can see probably all kinds of transactions are covered that we can think of. But then there are certain thresholds and certain categorizations which has been done. Now this categorization has been done. Now rule 114E, it provides that the reporting format shall be form 61A and it shall be filed on or before 31st May of the end of the financial year. What if we don't file, or what if we make a defect? In case the filing is defective, then I am given a chance of 30 days opportunity to rectify the defect within 30 days. Say, for example, I did a transaction with Mr. X, but then it was reported erroneously under the PAN of Mr. Y. I can rectify it just like a TDS return by filing the correct and revised statement. Let's say I file a statement and the defect is noticed by the authority. And if I still do not rectify that defect, in that case, there would be the penalty for not removing the discrepancy. So these are all penal provisions. In the interest of time, I'm not getting into each of these because they are very self-explanatory. Now let us see what kind of transactions are required to be reported. And what is the class of person or reporting person? The first one is the banking company. or a cooperative bank to which the banking regulation applies, including any bank or banking institution referred to in section 51 of the Banking Regulation Act. What kind of transaction? All are relating to cash. For example, payment made in cash for purchase of bank draft or pay orders or banker's check. Now, yes, so the first transaction is payment made in cash for purchase of bank draft or pay orders or banker's check of an amount aggregating to 10 lakh or more in a financial year. Now, what was happening, those of you who have not actually purchased the bank draft, so previously, now I think even for the registration which you do with the ICAI, you pay the exam fees, you pay the registration charge, all kinds of payments that you make are through the banking channel. Earlier, I'm not sure what is the situation today, but at least earlier, the situation was that whenever you want to make a payment, you have to do it through the DD, that is a demand draft. How do you get it? You go to the bank, whether you have a bank account or not, you can reach to any bank. You can simply pay the cash and the bank will give you the demand draft. That demand draft you can give to the institute against the registration fee. Now, what is happening here? While the institute charges a nominal fee, take the example, let's say the fees is charged by any institute, take XYZ, it is let's say 10 lakh rupees. You do not file your income tax return, you have got cash. What will you do? You'll pay cash to the bank, you'll get a demand draft of 10 lakh rupees. You will give that demand draft to the corresponding institute. Now, what is happening here? Now, nobody knows from where did you receive this cash, right? What was the source of cash? And that goes unaccounted. There are no checks and balances. So the government brought in this rule. They said that, okay, hey, look, bank, if a customer comes to your premises and if he is asking for a bank draft and in aggregate for a single person in an entire financial year, if the number of drafts that you draw is more than 10 lakh rupees worth, then you have to at least report this transaction to the income tax department by filing an SFT statement under section 285 BA. So this is basically to keep the checks and balances and to see whether the person who is buying the draft, is he capable, and yes, whether he has got any unaccounted receipts or not. That is the objective. Second, payment made in cash aggregating to 10 lakh or more during the financial year for purchase of prepaid instruments issued by the Reserve Bank. So I'm not discussing it much. It is on the same line. Third, cash deposit or withdrawal. This is important. Cash deposit or cash withdrawals in a financial year aggregating to 50 lakhs or more in a financial year in one or more current account of a person. So in a bank account, if you deposit the 50 lakh or more in a cash, or even if you withdraw it, then the bank is required to report it to the income tax department, including even if you deposit the money through a bearer check, even that is also required to be reported. Second category, cash deposit aggregating to 10 lakh or more in a financial year in one or more account other than current account and time deposit of a person. So if you deposit 10 lakh in a savings bank account or in any other kind of account, then the bank is required to report it. Or if you deposit it with the post office, even the post office is required to report. One or more time deposit, that we are talking about the fixed deposit, excluding a deposit which is made through the renewal of another time deposit, that we have to exclude, quite obvious. It is to be reported by a banking company. Simple to understand. Payment made by any person of an amount aggregating to 1 lakh or more in cash, 10 lakh or more by any other mode against the bills raised in respect of one or more credit card issued to that person in a financial year. So credit card payments, again, the credit card agency, which is mostly the bank, which is authorized, is required to report. The fifth in line is the receipt from any person of an amount of 10 lakh or more in a financial year for acquiring bonds or debentures. So a company which issues the bonds or debentures if it is receiving an amount of 10 lakh or more from a single person in a financial year, they are supposed to report this transaction. And likewise, in case of a company which is issuing the shares, again, the same threshold. If the company undertakes the buyback of shares from any person, and if it is a listed company recognized on the stock exchange, then if the value of buyback aggregate or single transaction is exceeding 10 lakh, you have to report this transaction in SFT. In case of a mutual fund, again, the same threshold of 10 lakh will apply. If the transaction is undertaken for, like here we are talking about authorized person as referred under the FEMA. Now, authorized person is nothing but under the Foreign Exchange Management Act. Usually the banks or the international agencies are authorized to act as an authorized person. Largely it is the banks. So authorized person, you may read it as a bank. If they receive from any person for sale of foreign currency, including any credit card of such currency to foreign exchange card, or expense in such currency through a debit or credit card, or through issue of traveler check. So if they receive from any person for sale of foreign currency, let's say I'm traveling to US. In US, Indian currency won't work. What I will do, I will make an arrangement with an Indian bank. I'll say, okay, hey, look, take the money in Indian currency and give me the equivalent amount of USD. If the value of transaction exceeds 10 lakh rupees, while the TDS or TCS provisions are still there for this transaction, the bank is also required to report this transaction if the transaction value exceeds 10 lakh in a financial year. 10th, if I purchase an immovable property, or if I'm a seller of an immovable property, and the value, recorded value of a transaction is 30 lakh or more, transaction value, or the stamp duty value as per section 50C is 30 lakh rupees or more, then the obligation is cast on the registrar of the properties to report this transaction. So you would have seen there is something called as AIS statement. Then there is something called as 26AS. 26AS is a statement when you log in, you see who all have made you payment and what is the TDS they have deducted, for which you will take a credit. Whereas in AIS, you are going to see all kinds of transactions in your financial history, which are reportable under the 285 BA. So if you purchase the property or a sale of property, you'll be able to see the transaction value on the portal. Any person who is liable for audit, now the reporting obligation is also cast upon. Now, in the previous sections, we saw that the obligation is largely on the authorized person, on the bank, on the registrar, or on the post office, and etc., which are largely the financial institution, and including the SEBI and stock exchange. But then, if a person is liable to audit under section 44AB, in that case, he also has to report certain cash transaction. What is it? That is receipt of cash payment exceeding 2 lakh for sale by any person of goods and service of any nature. So if you receive a cash exceeding 2 lakh rupees towards sale, then you have to report it under 285 BA. We all know this provision in practice. Now you might have seen many a time that when you are advising your clients and on the tax return filing, the first thing that you do is, while you take the details from your client, you'll also see his 26AS or his or her AIS statement on the Income Tax Act to map the transaction which is recorded in the financial. Many times you would have seen that the assessee has, like for example, if you're filing the return of a husband and wife, both of them have purchased the property, both of them have share of 50-50 percentage. The aggregate value of property is, let's say, 50 lakh rupees. Now, while the aggregate value is 50 lakh rupees, the transaction comes within the purview of reporting by the registrar, because he is not going to divide it among the two people. That is a reportable transaction. But ideally, because both of them are having 50-50 share, it should be reported individually in each account. In one person's account, it should be half. Other person's account, it should be half. But you would have seen in practice that a single transaction is reported in both the accounts. Likewise, if Mr. X and Mrs. X, husband and wife, they are having a joint bank account. And in the single bank account, if there is a deposit of, let's say, 20 lakh rupees. Now, bank is required to report this transaction. Bank is not aware who has deposited this amount. And likewise, if there is a fixed deposit in the joint account, bank has been asked to report this transaction in both the account. Many a time when we file the return, we get confused why this deposit is appearing in both the account. Now, this is because of this section. If you see clause C, it says the reporting person mentioned in column 3 of the table, while aggregating the amount for determining the threshold for reporting of the amount in respect of any person as specified in column 2 of the said table, will attribute the entire value of transaction to all the person in case where the account is maintained or transaction is recorded in the name of more than single person. So I specifically wanted to highlight this aspect because we do come across situation when we file the return, we see that a single transaction is reported in two different assessees. Now this is because of this condition. Either they are having a joint account or they are having the co-applicant in a particular transaction, or they are having a joint owners. They are the joint owners of the property. That is the situation it is required to be reported. And likewise, there are other situations, like for example, you have to take into account all the accounts of the same nature. So if I'm having a two savings bank account, you have to club, you have to report both the account. You can't divide it. For example, in two accounts, I have made 5 lakh rupees deposit, you report both. Then thereafter, there was an expansion of reporting mechanism. They said that in previous section, there were certain values like 30 lakh rupees, 10 lakh rupees, and Rule 114E, Sub-Rule 5A, that was amended to provide that information relating to capital gain or transfer of listed security or units of mutual fund, dividend income or interest income. Again, three categories of income: capital gain on transfer of listed shares, dividend income, or interest income. These three categories of income are required to be reported. Now, who is the reporting person? And that is irrespective of the threshold. There is no threshold. Even if you earn 1 rupee of interest, bank has to report. If 1 rupee is the dividend, company paying dividend has to report. If there is a nominal amount of capital gain, even if there is a loss, capital loss, still the stock exchange is required to report the transaction. While the usage of the word is capital gain, they are referring to the capital gain chapter. They are not saying that there has to be a gain. If there is a transaction, you have to report. That is why you see that in AIS these days, your entire transaction which is undertaken through the stock exchange gets reflected in your AIS with the purchase, sales, and profit values. And likewise, dividend and interest. These transactions these days are auto-populated in your income tax return. Like for example, if it's a dividend income, you will see once you log into your portal, you open your relevant ITR, dividend income is automatically shown in your schedule IFOS. The information is to be reported for all account holders where any interest exceeds 0 per account in the financial, excluding Jan Dhan accounts. Now, let us discuss the penalty for failure. If the assessee, that is the reporting person, fails to report the transaction, then there is a penalty by way of 500 for every day during which the failure continues. And likewise, even after intimation, if the failure continues, then there is a penalty of 1000 per day for a continuing default. So there is a bar against the imposition of penalty. Section 273B, which is a very general section, not specific to 271 FA. You will discuss in detail in a penalty chapter, where the assessee proves that there was a reasonable cause for the said failure, then penalty can be waived by the specific officer. This is a very simple illustration. Let us solve it. You can read it and then relate it with the provision itself. I hope the speed is okay and voice is audible. In case you want me to sort of go slow, you can let me know. As you see, the notice was issued on 1st October, and the deadline to file the statement was given as 31st October by the officer, whereas assessee filed the SFT form after the deadline. So the period is 31st May is the last date to file the SFT form. So from 1st June to 31st October, the penalty is 500 per day for 153 days. After the notice is issued, that is the deadline to file the SFT was 31st October, but you did not file. So for 15 days, there's a penalty of 1,000. So total penalty is 91,500. But then you also have to write that under 273 capital A, the officer has the power to provide a waiver from the imposition of penalty if there is a bona fide case for failure. So we are not discussing much this penalty because there will be a duplication. We're already going to have a session on this. Now let us discuss AIS. Now again, we'll just briefly touch upon it. AIS is nothing but an annual information statement. You all can see when you go to the income tax website. Now the section just is an enabling section. We can just glance through this and not much to discuss. Like once the bank is updating the information, filing the information SFT form, or assessee is filing the SFT form, the obligation is on the authority to load all the information into the registered account of the assessee. So all this you might be familiar with already with when you would have logged into the income tax website. You can see your TDS, TCS, your SFT, whatever taxes you have paid, demands and refunds, all kinds of ongoing proceedings, and the proceedings which have been completed along with the records. So this section just empowers the central government to publish the name and address of any assessee relating to any proceeding or prosecution. So I think previously it was very often that was happening that the information relating to habitual offenders or those with a lot of huge demands but persons not traceable. So all those proceedings, name, address, face of the person that was uploaded on the website and that used to get uploaded on the newspaper and news articles as well, to know the whereabouts of those persons. So this is the section that basically empowers the central government to do so. Appearance by registered valuer. Now, simply put, the section says usually the right to defend himself is with the taxpayer, but then the section says that even the registered valuer can also appear on behalf of an assessee if the matter relates to the valuation of any asset, because it is the expert who can explain it better. So registered valuer can appear either before the tax authority or even before the appellate tribunal. Except otherwise, then he is required under 131 to attend personally for examination on oath or affirmation. Now, section 131 is a specific section which calls for the personal attendance of an individual. If the notice is issued pursuant to 131, then no authorized representative, forget about registered valuer, even an authorized representative cannot appear on your behalf, on assessee's behalf, because 131 is a section which requires personal attendance. Then we have section 288, which deals with appearance by authorized representative. Now, you might have seen that many times in assessment proceedings, appeal proceeding, or even before the ICAI, you would have seen we call to the assessee and we tell them that, okay, we'll be able to represent you, provided you give us the letter of authority. We seek the letter of authority because that is coming from section 288. The primary obligation to represent himself is on the assessee. It is not mandatory that assessee should be represented through the authorized representative only. So there is one question. If the notice is in a faceless manner, then how the appearance can happen physically? Now, see, previously the assessment proceedings were conducted in a sort of face-to-face physical manner. Like you can see the tax officer, you can discuss with him personal. But they introduced the concept of faceless assessment, where the notice will come to your registered ID. You cannot see who has issued the notice. You cannot see who is going to conduct your assessment. And the notices will come. You have to file the reply. And then at the end of the proceeding, we ask for the personal opportunity of hearing. Now, at the time of personal opportunity of hearing, now there is a facility which is created on the portal, whereby through assessee's login, the assessee can authorize any other professional in line with the compliance with section 288 of the Act to represent him before the assessing officer. So previously it was the chartered accountant or any other sort of a professional that was authorized to appear physically. But because of technological changes and faceless assessment, now even an authorized representative can appear online and through virtual sort of they can carry out the deliberations and represent the assessee. So that facility is now there. See, I think someone asked in a faceless assessment. Now, please note that in a faceless assessment, it is the assessing officers whose face you cannot see. Your face assessing officer can always see, because when you practically do the assessment, if you have seen the assessment or any kind of hearing, if you have attended, then you would see that on the screen, still during the hearing phase, you can listen to the tax officer, but you cannot see the tax officer. But on the other way around, the tax officer can see you, and you can even call for the recording of that meeting. The more of that will be discussed in the chapter relating to assessment procedure. Section 288 deals with the appearance by the AR, authorized representative. Assessee has been allowed or entitled or to appear before, if he is required to appear before tax officer or a tribunal in connection with any proceeding, except section 131, as I mentioned, he may represent himself through the AR. Now, what is AR? Who can be an AR? That is also defined. It is not anybody or any person can represent the assessee. It is only those specified persons. Who are they? The first, the person related to the assessee in any manner or a person regularly employed. So it can be either a relative or an employee of the assessee. Officer of a scheduled bank where I have got a bank account. You will be surprised to know, usually you might have come across the cases where either an advocate or a chartered accountant appears. But look at this definition. Even the employee of the assessee or even the bank where I have got an account, the manager of the bank can also, officer, not even a manager, any officer of the bank can also go and represent the assessee. Legal practitioner who is entitled to practice in any civil court in India, an accountant, then there are certain exclusions given. We'll not get into it much in detail because that is self-explanatory. First, let us see who are eligible. Person who has passed the accountancy examination recognized by the board. Now, Rule 50 prescribes the accountancy examination which are recognized. Diploma in commerce by so-and-so. Government diploma in company secretaryship awarded by the Department of Company Affairs. Final examination of ICSI. Final examination of ICWA. Departmental examination conducted by the Central Board of Direct Taxes. So if any person has appeared in a departmental examination, he can also appear, or revenue audit examination of section officers conducted. So all these persons can appear. Then any person who has acquired such education as the central government notified. Now, what are the degrees that they have prescribed? Let us see. Any commerce or law degree. Commerce or law degree. That is important. From where? From any Indian university, Rangoon University, English or Welsh University, and then there are certain names of the foreign universities, Scottish, Irish, or even the Pakistan universities. So why they have mentioned this? Because, even before the partition or before independence, a lot of people might have done their might have obtained their degrees from these university, or even afterward also. Majority of the education system that is there in India, it is largely aligned to what is happening in these countries, mostly the UK. And therefore, they have allowed through this memorandum and all that those who have got those degrees from this university, they can also be allowed to appear before the tax officer. Who is not? That is very important. Who cannot appear? Person who has been dismissed or removed from the government service. Person who has been convicted of any offense. Person who has become insolvent. Person convicted by a court of an offense involving fraud. If any person is a legal practitioner or an accountant and is found to be guilty of misconduct in his professional capacity by an authority entitled to institute the disciplinary proceeding, it can be ICAI, Bar Council, Chartered Company Secretary, or CWA Institute, whatever. So under all those, if a person is not a legal practitioner, an accountant, but he is found guilty of misconduct in connection with the income tax proceeding, even that may also bar him from appearing on assessee's behalf. So this is general. Then the definition of relative is also provided. Who is relative? Spouse, brother, sister of the spouse, lineal ascendant or descendant, any lineal ascendant or descendant of the spouse of the individual, spouse of the person referred to in BCDE, or any lineal ascendant of a brother or sister of the individual or his spouse. So that was all about section 288. Power to tender immunity from the prosecution. Immunity means the protection. Prosecution means they prosecute you for any kind of offense that you might have committed, and that offense is of such a severe nature that it calls for the prosecution. Now, in this section, the central government is empowered to tender any person immunity. Immunity means a protection from the prosecution from any offense which he might have committed under the Act, provided the government is of the opinion that it is necessary or expedient in the public interest. When the public interest is involved, please note that the condition here is not that you asked for the waiver or relaxation from the prosecution. The condition is we are not going to prosecute you because it is in the interest of public. If that is the case, then the government is empowered. Say, for example, take a situation where you give some information to the tax officer and you say that you have been party to that offense, but because you are cooperating, collaborating, and you are going to cooperate more so that more of certain things can be unearthed during the course of investigation, and you assist the investigating authority, the government may say, okay, hey, look, while we may not give you the waiver from the penalty and demand, but then of course from the prosecution, we can give you an immunity because that involves a larger public interest. The prosecution will be only in relation to the specific event. It may not be from any other kind of, for example, the government may give you a waiver or sort of a relaxation from prosecution. But if you have done any other kind of offense under the criminal law, you may not be sort of relieved under this act. Cognizance of offense and bar of suits in civil court. Now, this is also very important. What it says, no court inferior to that of a presidency magistrate or a magistrate of the first class shall try any offense under this act. Now, you would have come across, I'm not sure whether you have been through the penalty and prosecution chapter. Under the income tax law, there are provisions, like for example, if you do the tax evasion, while there will be a tax demand, then there would be a penalty. If the cases are of a serious nature, for example, you deducted the TDS of someone, but you did not deposit. Now, technically, this is the government's money which you retained with yourself. So then there's a provision in the law that allows or that empowers the officer to launch the prosecution. That is basically to put you behind the bar. Now, the officer will file a complaint before the magistrate court. The section says that it says bar of suits in civil court. No court inferior to that of a magistrate of the first class shall try any offense under this act. So there are various categories of courts. So they say that the court which shall try an offense under this act shall not be inferior to that of a magistrate court of a first class. In case you go to any junior court, then the magistrate court, that court has no power to entertain your matter. Second, no suit can be brought in any civil court to set aside or modify any proceeding taken or order made under this act. Now, for example, assessment is ongoing or assessment order is passed in your case. Can you go to the court to say that the assessment is not happening as per the law and accordingly you ask the court for some relief? Answer is no. They say, number one, you cannot go, and number two, they put the bar on the court also. They say that, hey, look, not even a civil court can set aside or modify any proceeding which is taken or order is made under this act, and no prosecution, suit or any other kind of proceeding shall lie against the government or any other officer. Now, this is the second part. They said that when the officer is doing its duty, you cannot file a case against an officer or against the government for anything which is done or intended to be done in good faith under the Income Tax Act. Say, for example, the assessment is ongoing or a search has taken place at the premises of Mr. X and his family. Because he said that, oh, there's a search that is happening, he might get a heart attack. If that is the situation, if there is anything which is of a medical nature, or he might go mad, he might go lunatic mind or whatever it is. So he suffers any kind of infirmities. In that situation, can you sue the officer or the government in a court of law? The answer is no. You cannot, because whatever they have been doing, they are doing as a part of their duty in a good faith. But if the good faith is not there, in that case, you can definitely sue them for all kinds of damages that you might have incurred. Certain laws not to apply. Now, this section provides that Section 360 of the Code of Criminal Procedure or the probation of offender, they will not be applicable to any person who is convicted of offense under the Act unless the person is under the age of 18. Return of income not to. Now, this is the most important, where I think we should spend 5 to 10 minutes on this section. First, you carefully read this provision, because not only from the academic point of view, but even from the practical point of view, this section holds a great importance. I'm giving you a good time of 5 minutes. Read it properly and memorize it properly forever. Not only for exam, but forever. Meanwhile, if anybody is having any query, you can put in chat box, you can ask me. Asking would be better than typing. After reading, I want one of you to at least explain what you understood. Or if anybody is already aware of this section, you are welcome to participate in the discussion. Someone is writing, bona fide mistake or error can be accepted. But you have to be elaborative on this. What? Can you give some instance? Even that bona fide mistake and error, that is an unwritten law. You need not specify with a section. But little bit of importance of this section. With some example that would help, because I'm sure practically you might have come across this section many times if you are practicing the tax law. Let's say today is the last day for the officer to pass an assessment order. He says like, oh, I'm not keeping well, let me do it tomorrow. Or otherwise, let's say he feels like, I forgot to pass the order, I'll do it tomorrow. And then he recollects, okay, today it's 18th and I was supposed to pass the order yesterday. Let me do it now. And he requests the assessee to accept the order. Is that okay? Answers are right. Bona fide mistakes, errors can be accepted. assessee not taking advantage of loopholes of law. But my question is, different. I'm saying, for example, the last date to pass the assessment order is, let's say, 31st of March. Assessing officer forgot to pass an order, and it is a bona fide mistake. He forgot. He had drafted the order, everything was ready, but he forgot to sign it and serve it to the assessee. Can he do it on first? Is that okay? Because we have said that no return of income order of assessment made, taken, or purported to have been furnished or made in pursuance of the act shall be invalid merely by reason of any mistake, defect, omission in such return, assessment, notice, summon, or other proceeding, if they are in substance and effect in conformity with the intent of the Income Tax Act. Anybody would like to volunteer, or should only I have to speak for 3 hours? Can we not make it interactive?
Sir, you have told that the assessing officer has uploaded the order without signing.
He has uploaded on 1st April. He was supposed to do it on 31st March. He drafted the order, but he was getting late for some work, so he sort of missed out of it. And then on the next day, 1st April, he quickly signed it. He told his staff to upload the order, and assessee received it on 1st. Is that okay? Take another example, and we'll try to answer all these examples. I'm creating the examples from the practical case law perspective. Take a second example, and you note down the example if I forget to answer. Okay. So first example we saw issuance of belated order, right? Second example, let's say I passed the order, I communicated it on time, but instead of mentioning the PAN number of Mr. A, I mentioned the PAN number of Mrs. A, and I communicated the order to Mr. A. So there was a typo error in the PAN. This is second example. Third example, I did a typo error, but then I communicated the order to the wrong person. So typo error plus wrong person. Fourth example, say for example, you all know the meaning of the word jurisdiction, right? Anybody wants to volunteer? What is jurisdiction?
Yes, sir. In assessing, in all pen are allotted to a state judicial officer. You can go for assessment and pen resubmission.
Right. So for all assessees, for different class of assessee, there are different class of tax officers. Now each officer is called a jurisdictional officer. He can only deal with the matters relating to his jurisdiction. Like we have police stations, wherein we see that a particular police station will have a jurisdiction over a particular area. Likewise, in the income tax, there is an officer who has a jurisdiction over a particular area. Say, for example, Mr. X comes under the jurisdiction of Mr. Officer 1. The CBDT issues the transfer order for Officer 1. Or alternatively, take another example. The CBDT says that from today onwards, the jurisdiction of Mr. X will not be ITO 1, it would be ITO 2. But the assessment was previously being carried out by ITO 1. He did not pass the order. In the meantime, CBDT issued the transfer notice where the jurisdiction of Mr. X was transferred from ITO 1 to ITO 2. Now, ITO 1, while he was communicated the order of CBDT properly, but then he made a mistake, a bona fide mistake. He continued with the assessment and he passed the order. Right? You understood, right? ITO 1 passed the order, whereas your jurisdictional officer is ITO 2. Fifth example. Officer issued the notice to Mr. A, who has passed away long back. And then he realizes after completion of assessment, oh no, I did an assessment in the name of a person who is dead. But then he said, okay, I'm still a right in my jurisdiction to do the assessment in the hands of a dead person. Because for the year in which I'm doing the assessment, that person was alive. So assessment of a dead person. That is a fifth example. Now, let's take one more example. Okay, typo error we have already taken. So the courts have time and again dealt with these issues, and in different scenarios, the courts have taken a different view. For example, if it is a mistake, defect, or an omission in the order itself, but at the same time, please mark the words, what it says. This is very important. If they are in substance and effect in conformity with, according to the intent and purpose of the Income Tax Act. Now, while there is a mistake, defect, and omission, that is understood. But then at the same time, such written order, notice, assessment, summon, or any other proceeding, they must be in substance or in effect in conformity with or according to the intent and purpose of the income tax law. So if I'm doing a typo error as an officer, that typo error will not invalidate the assessment. Take the first example. I have issued the belated assessment order. Belated assessment order is not a typo error. It is a failure to comply with the deadline prescribed under the income tax law. If you breach the provision of law expressly, then whether it is a mistake, defect, or omission, we are not going to pardon it. That renders the entire assessment invalid. Second case of typo error that we already attest, that is pardonable. Then another case was an ITO case transfer. In this example, as I mentioned, the assessment was carried out of Mr. X was being carried out by ITO 1. In the meantime, while the assessment is ongoing, CBDT issued an order that jurisdiction of Mr. X will transfer from ITO 1 to ITO 2. ITO 1, he might have read, he may not have read, but he continued with the assessment, he passed the assessment order. This is the case of a jurisdictional defect. The court says the jurisdictional defect is not a curable defect under section 292B, and therefore this defect cannot be cured, and this will render the entire assessment invalid. You will see different case laws in different contexts, but all point to the same thing, that if there is a jurisdictional defect, that cannot be cured. And likewise, the assessment of a dead person is also a jurisdictional defect that cannot be cured. That is the sum and substance of section 292B. Now we have only, I think, 10-15 minutes. We'll expedite on the remaining provision. Notice deemed to be valid in certain circumstances. Assessee would be precluded from raising any objection in any proceeding or inquiry that the notice was not served upon him, or it was not served in time, or was served in an improper manner, if he had participated if he had participated, appeared in a proceeding, or cooperated in any inquiry relating to an assessment. Now, what does this say? Officer was supposed to issue the notice by 30th of June, right? He issued the notice in the month of July. That notice technically is a time barred notice. But assessee cooperated in the proceedings, and after cooperation, the order was passed. Then the assessee cannot raise an argument that, oh, look, the notice was not issued in time. In that case, the contention will not be accepted. Why? Because he has already appeared in the proceeding, he has cooperated in the proceeding, he has cooperated in the inquiry. That is why in the beginning, if you recollect, when I was discussing the manner of service of notice or communication, I said that when we receive a notice on behalf of a client or we see the client's notice, we immediately start writing the submission. We forget that this is also very important. When you see the notice, you see how it is served, where it is served, whom it is served, what is the PAN, whether the officer serving the notice is a jurisdictional officer, the attachment contains his signature, is it digitally signed, and the most important, I think that part is not there in this module, whether the notice has a DIN or not, document identification number. That is also most important. If that is not there, it renders the notice invalid. And likewise, if, let's say, despite these faults in the notice or the manner of assessment, if the assessee continues to participate, then later on you cannot take an argument, sir, I forgot to take this argument earlier. Now I want to challenge this notice. No, sir, sorry. You have already participated. आपने सब disclose कर दिया है. The order is passed against you. Now don't take this argument before the officer. However, such deeming provision will not apply where assessee has raised an objection before the completion of assessment. असेसमेंट कंप्लीट होने से पहले अगर आपने ऑब्जेक्शन रेज कर दिया तो फिर आपको फायदा मिलेगा. 30 जून का नोटिस जुलाई में रिसीव हुआ, 31 मार्च नेक्स्ट ईयर तक असेसमेंट चलेगा. मार्च के बाद ऑब्जेक्शन हम एंटरटेन नहीं करेंगे. बिफोर मार्च, इफ यू रेज दिस ऑब्जेक्शन बिफोर द ऑफिसर के द नोटिस which was issued by you in July that is invalid, we can still accept that argument. Then 292 capital C, presumption as to assets, books of account, etc. Essentially what this section says कि जब सर्वे होता है, सर्च होता है, at that point of time if the assessee is found to be in possession of any asset or books of account, आपके पास कुछ बुक्स मिले, कुछ चिट्ठियां मिली, कुछ एसेट्स मिले, नेचुरली आप डिनाई करोगे कि ये मेरा नहीं है, ये किसी और का है. बट लॉ सेज कि वो डिनायल को हम नहीं मानेंगे. आपके पास अगर कोई चीज पड़ी है, दैट असेट बिलोंग्स टू यू, दैट इज व्हाट वी विल assume, we will presume, and this is by virtue of the provision of the law. It will also be presumed that the content of the books of account are true. The signature and every other part of books of account and document which purport to be in handwriting of a person are in that person's handwriting. In the case of document is stamped, executed, or attested, that it was duly stamped, executed, and attested by the person by whom it purports to have been executed or attested. 292C was inserted to clarify that the presumption provided in 132(4)(a), it can be made in any proceeding under this act. It would also be available for regular assessment. So this is all about this section. Not much to discuss. Then section 293C, it says the central government, the board, and the authority, they are empowered under the provisions of the act to grant the approval. There are various types of approval that they can grant. For example, if you want to claim an exemption being a charitable trust under section 12A, receive an approval, no problem. You have received an approval. But then the section says the authority which is empowered to grant an approval, it has an inbuilt power to withdraw the approval. So once the approval is granted, that may be forever, that may be for a particular duration, but even prior to that, the same authority can also withdraw the approval. That's a general provision. Act to have effect pending legislative provision for charge of tax. Now, this is also very important. It says that if on the 1st April in any assessment year, the provision, so we all know that every year, so basic provision, section 4.5, the charge of tax is on an income. The rates are prescribed by the Finance Act every year. Finance Act ke pehle, we get a finance bill in a budget during the budget announcement. Now that bill goes through the discussion, it is enacted and it is signed by the president, and then finally it is enforced. Now, if for example, for whatever reason, as on the first day of the assessment year, if any provision is not enacted by the Central Act for charge of income tax for that assessment year, can I take an argument that for whatever reason, if the budget is not there, finance bill is not there, the rates of income tax which were prescribed for the previous years, they are not in force. This year, I'm not going to pay the income tax because there is no finance bill, there is no finance act, nothing has been enforced, so I'll not pay income tax because the rates are for a particular assessment year. You can read section 4, that is for your homework. Section 4.5, charging sections. They say that the tax is on total income by the Central Act. Now that Central Act is there every year, Finance Act. If that is not there, can we take an argument that I'm not supposed to pay any income tax at all because government has not notified the income tax rate? But then government says, wait. Section 294. If on the 1st April in any assessment year, provision has not yet been made by the Central Act for charge of income tax for that year, this act shall nevertheless have effect until such provision is so made if the provision is in force in the preceding year and the provision is proposed in the bill before Parliament, whichever is more favorable to the assessee would be actually in force. Then finally, the last part, the power to issue the rules. Rule making power has been with the CBDT. CBDT can make the rules for the whole or any part of India for carrying out the purpose and implement the act. So they are subject to the supervision and control of the central government. So I think with this, I would like to end my session for today. I hope you all liked the session. It was very, sort of a smooth one, at least for me. If you have got any questions, please feel free to ask. These are the schedules to the Income Tax Act for your information. Anybody having questions? So someone is writing part 1 of first schedule will applicable. I could not understood the question. Can you please elaborate on this? It is in okay, part 1 of first schedule applicable. But then this section is not about this. It says that pending legislative provision for charge of tax. It says again, if on the 1st April of an assessment year, provision has not yet been made by Central Act for charging income tax for that AY, then this Income Tax Act shall nevertheless have effect until such provision is so made, as if provision in force in the preceding assessment year. So last assessment year, last AY, or the provision proposed in the bill which is pending before Parliament for passing, whichever is more favorable to the assessee, were actually in force, that would be applicable. Any other question? So see, whenever you read the law, while I think the syllabus would be large, income tax is very vast, always focus on the provision and see the rationale of the provision. If you understand the rationale or reasoning of the provision, why this provision exists, what is it that it is trying to address, then it is very, very easy to remember it. Even you don't have to remember or recollect anything. It will be automatically in your mind. So if you see all the sections which we discussed, all sections we discussed with a purpose. We did not read it as it is. We are first discussing the purpose. So in the same manner and fashion, if you do it for all other laws also, like if you have company law, you might have FEMA, allied law, SEBI. So all these things are there, GST. Just try to find the reason for why this provision. Then the things will become very easy for you to understand, and it's all logic then. All right. So I believe we do not have anything to discuss. So shall we close? Ashokji? Yes, I think there are no questions. Let me see. I think there are no questions. Thank you. Good night, everyone.
Thank you, sir.
Thank you.